I want to welcome everybody today to our ongoing educational series that we do on a monthly basis. And today's topic is an exciting one, and I think a very timely one: strategies to attract, retain, and reward key employees. My name is Fran Lynch. I'm the managing partner of Strategic Lifelines. My bio is here. It's not really that important. Been in the industry over 20 years, specialize in working with small business owners and also with high net worth and high income individuals, specifically in tax recovery planning and employee and executive benefit planning. We've got two great speakers lined up today that are both consummate experts in this field. And just to remind you, Strategic Lifelines is a direct resource to accountants, financial advisors, estate planning attorneys, and other tax professionals to help their high net worth and business owner clients mitigate the impact of taxes and leverage multi-generational wealth and legacy planning through the use of the most advanced tax planning strategies available under present tax code. Our intellectual capital guides high income and high net worth individuals to create awareness of strategies that were previously unknown to them. So again, as I said, today's topic are strategies to attract, retain, and reward key employees. I've had the wonderful opportunity over many years now to interact with a lot of business owners, both small business owners, mid-size, and large business owners. And when I ask them what the key to their success is, I hear a multitude of things, but probably hear several things repeated more often than not. Most of them have a very clear vision and a mission statement of what it is that they want to build. They also have very specific goals and objectives. They've come up with initiatives that their company is going to undertake to attain those goals and a very specific action plan. But one of the other things I hear time and time again is the importance of having good personnel. No business owner will ever tell you that they've attained the success that they have solely unto themselves, but the importance of their team and having the right members of the team doing the right things on that team. And we're in a very interesting moment, really, in the business world. As a result of the pandemic, we're experiencing now what a lot of people are referring to as the Great Resignation or reassignment. And I don't think I've ever seen a market where I would call it an employee market, where a lot of the employees now are looking for better opportunities, or they're leaving their present employer. And that's why I think that this is a very timely topic, especially moving into the first quarter of next year, when employers should be considering what's the best way to attract, retain, and reward their key employees. So I believe it's a very timely topic that we're addressing today. So I just want to start, before I turn it over to our first speaker, with a couple questions. Is there any one person or persons who, if they never showed up again to work, whether they quit, they died, or became disabled, would affect your business? If you're closing down your business and going across the street to start a brand new business, who would you absolutely take? Is there any one person or persons who your life is better working with? These are a few questions we'd like you to keep in mind as we go through today's topic. So our first speaker is a longtime friend and business partner. Gene Frost's been in the industry over 40 years. Way back in his early 20s, he was fortunate enough to start in the executive and employee benefit arena. And he is one of the consummate experts, having been around the industry and working in employee and executive benefits for over 40 years. I'm going to turn it over to my partner, Gene Frost.
Thanks, Fran. Great introduction. Before we kind of, most of us work in privately held businesses and family-owned businesses, but I kind of always say, let's look at what public companies do first before we kind of look at what gets trickled down to the private market. And one of the interesting things is when you talk to a public company, they always want to know, what are their peers doing? They hire compensation experts to kind of review what the market bears, what people are doing, and they view people as their resource, and they're really competing against. They view the best and the brightest. They're looking at the people, the business schools, the lawyers, the accountants, and they're just trying to get the best possible people. And they hire management consultants to look at what's the compensation, what's bonus, what are the incentives, what are the supplementals provided. And their goal always is, how do I keep these people, attracted to my company and retain them long term? Because they view them as the most valuable resource. And isn't the market of your business a result of the people who show up every single day and do their job? And it's just, and then if we take a look at what they do for benefits, is if you sit down with a company, they'll have a layer of group benefits. And then what they will do is they'll say, for my highly compensated, for my key management team, I want to go above and beyond traditional benefits. So in many cases, they'll put in a supplemental term plan. They may provide post-retirement death benefits. They'll look at their disability plans, and disability actually is reverse discrimination, because most group disability plans cover 60 to 66 and 2/3 of base salary, and there's a cap. And usually that cap is based upon the first 200 of compensation. And what happens with the executives making 5, 6, 700,000 a year? So they'll put in an extra layer of individual disability as a way to provide for that executive. And then they'll look at going above and beyond the 401k plans and put in some retirement plans, whether it's a SERP, which is employer paid, it can be a lump sum, it can be, can be designed as a defined contribution. They also do, and Bob has done a lot of these over the years, executive deferral plans, where they'll try to mirror image a 401k plan, but set up in a non-qualified plan. And obviously they do all sorts of various stock options that reward them in the participation in the growth of the company. And so the question becomes, why not trickle these down to the non-qualified world, where actually it's probably even harder to find the right people to replace. And non-qualified benefits allow you to selectively pick and choose who you want to reward, retain, and how you want to design it. And if done properly, you can really design and, in a sense, completely tailor-made what you're trying to accomplish for those companies. So what I wanted to do is kind of go through and just to kind of give you some case studies, and because I think, one today, I don't expect you to remember everything, but I think if you see the case studies, you can kind of see where these play into place. So this is a company, and this is a very simple plan, but it shows you how you can go from the simple to the most complex. And the simple side is, this was a sales organization where they had 3 rock star salespeople. All of them were under 40, all married with kids. And the goal was, I don't want to spend a lot of money, but I want to give them something special. I want them to feel important. So we did is we added $2 million of term life to protect their families. We gave them each $10,000 a month of supplemental disability insurance above their group plan. So if they got disabled tomorrow, they had that additional $10,000 a month coming in for their family. And then we gave them a very unique benefit. And if they got disabled, we actually insured their 401k deferral and match on both the employer and employee side. And so that anything happened, their income was replaced to a certain extent, their retirement was secure, and their family was taken care of if they died prematurely. And at their ages, this was all done under $400 a month per participant. So for a very small amount of money, they made them feel very special. Another example is I had a large manufacturing company with the dad 68. Their 2 sons come in the business, not ready to run the company. And the goal was to, and they have a key person who's 55 years old as a president. And my client said to me, I want to keep this guy tied into the company. I want to make sure he's there to help the company grow. I want to make sure he's there for my sons. So we did 2 things. We targeted a lump sum of $500,000 a year for him at age 65. And each year he stays, we'll increase that benefit by 10%. And we also want to make sure that if we sell the company in the future, or there's a performance growth, is an opportunity to hit another $1 million of additional based upon a formula. So this person is sitting here going, if I just stay until retirement, I got $500,000. And based upon a formula, I'm going to get a phantom stock plan, which is a formula based on the growth of the company, all agreed upon how we're going to value it. And there'll be an anywhere from 0 to almost $1 million cap designed in this benefit. And that was, and they kept them tied in the company and they were very happy. So that's one example. And the last one is a family-owned business where the owners are all much older and it has a very young management team. And the management teams are not the owners. And the goal was, we want to provide them a benefit, but a retirement benefit's meaningful because we're going to probably sell this company in the next 10 years. So why do we want to provide a benefit that they're not going to be here to enjoy or participate in? So we designed a plan. We did a rolling bonus where we put aside some money for 5 years, and we did a vesting schedule. At the end of 5 years, they become fully vested, and they can take that as a lump sum. And if they're still here, we can do a brand new plan. So the idea was each year we're going to give them a unit. In this particular case, everybody got $25,000 a year as a unit going forward. At the end of 5 years, that got paid out. And then in addition to when we give an interest credit, and we also put in a phantom stock plan based upon a formula that triggered if the company ever got sold, they could participate at some level in the growth of the company. And these are just kind of ideas as to what can be done in these situations for these people. We can target for retirement. We can target a lump sum. We can target retirement death benefits. We can add individual disability. We can protect their, their retirement from disability by putting in their 401k plan to be insured. And all of these things are totally pick and choose and selective. Next slide, Fran.
Thanks, Gene, very much. I always think the best way to illustrate things is by way of example. 3 great examples in a multitude of different ways that you can reward and retain good talent in a business. So, Gene, you want to just sum up?
Sure. So effectively, the beauty of these things is these are totally pick and choose and selective. You can pick up for one person. You can do it for groups of people. It can be different levels for different people. You can design your own benefit, your own formulas. You can control the vesting schedule if you want it inside the company. For retirement, it could be a lump sum. I've always found for small privately held businesses, just targeting a lump sum, so there's an immediate payout at age 65 is a lot easier than it is to have a payment of like for 10 or 15 years, but everything can be designed based on your goals and objectives. You can do it as a defined contribution. I would like to put away $15,000 a year or $50,000 a year, whatever number you want. You can target a defined benefit if you choose. Here's 25 grand a year or 100 grand a year. And you can either fund it or unfund it. And most of the time, what we do is we fund these liabilities because you don't want to strap future management with today's promises. So we set a plan to properly fund it along the way. And for life and disability, we can do different things for different people. We have plans where we might give one group of people 2 million of insurance, another 1 million, another 500. We have so many different things we can do in these things, but remember the magic word is pick and choose. You can select and you can design it any way you want to design. But the goal is how do I keep my key people happy and how do I compete in the marketplace? And I'll turn it over to my good friend, Bob McCarthy. I'll let Fran,
Great. Thanks, Gene. So our next speaker, I've only known him as an expert in the executive benefits space. Been working with him for over 20 years now. I work with the Todd organization, which was one of the largest executive benefit organizations for many years. Now is the founder and principal of MacArthur Financial, his own company. And he is really a specialist in executive benefits. And MacArthur Financial has been around since 1990, consulting with for-profit and nonprofit companies to design, implement, finance contemporary executive benefit programs which help recruit, retain, and reward key talent. And the whole idea is that comprehensive financial planning services for senior executives and business owners is the key to his organization. Just a simple disclaimer here that the materials in the webinar are for informational purposes only and are not intended to or do not constitute legal or accounting advice. These are general concepts. Every specific individual situation is different. The information in the webinar is current as of December 14th, 2021, and can be changed daily. So that said, Bob, I'm going to turn it over to you.
Great. Thanks, Fred. I appreciate the introduction. So we'll just jump into a fourth case study. And more times than not, especially in the privately held companies we work with, we're asked about performance-based programs. Is there a way to tie not only the employee to the company, but the plan to the company if we're putting in a program? There's some hedging as to, from the company standpoint, as to how much they actually want to contribute or finance for this if the company doesn't perform very well over the next 5-10 years. Conversely, obviously, there's the carrot that they'd like to offer their, especially key talent, a piece of the pie. If the company does very well over time, then they also feel that it's the program is completely aligned with the values of the company. So this is a sample incentive plan we put together for a privately held tech company that was interested in establishing a customized retention fund, performance-based, that would vest to certain key employees over a 5 to 10 year period of time. So we helped design a non-qualified program with the following plan design features. Since growth was a key metric for ownership, the contribution formula was designed to factor in the year-over-year increase in sales. The increase in sales is an important phrase. And they also put in a second discretionary contribution option, which was based on the net profit over the same 12-month period of time. So once the total fund was determined at the year end, a percentage was credited to each executive's account that was established and is based on their position and tenure with the company. So to Gene's design feature in an earlier case study, you could not only pick and choose who participates in this plan, but you could decide to finance it or to promise essentially a different amount for different employees. So there's a lot of flexibility in here to the company. And Fran, if you could flip to the next slide. There was a 7-year vesting schedule, rolling 7-year vesting schedule that was adopted. Importantly, the income taxes are deferred until the executive actually left the company. And payment elections could actually be made as a lump sum, which is usually preferred, or annual installments. And under this scenario, they were relatively highly compensated, and they actually used this program for tax planning. And a couple of them opted into a 10+ year annual installment when they left the company to spread out the income tax payments. The executives, one more bullet. An important piece of this is actually the executive's ability to defer a portion of their base salary and bonuses each year into the plan. Again, we had some highly compensated folks who really took advantage of this. The program was established by the company for company contributions, but we put a leg in here for the executives to defer their own cash compensation, and several of them took advantage of it to supplement the company paid account over a longer period of time. The client also engaged us to draft the necessary 409A compliant plan document. The 409A is the legislation that was passed years ago to formalize a deferred compensation arrangement, and the Department of Labor registration statement that's required. They also asked us to source an experienced plan administrator and a funding specialist to communicate and implement the plan. So there's multiple legs in these programs. The plan design is important, but we also need specialists to implement the plan and to administer the program over time and to finance it correctly. So there is a bit of a domino effect here, which is important to incorporate in whatever planning you decide to implement. We also provided financial planning services. That's a unique attribute of my firm, holistic planning service for highly compensated executives. And we essentially dovetailed this program with their overall retirement and wealth management plan. So it was a seamless plan from the company's rollout to the individual understanding the program to leveraging it to their best or to their individual objectives, for instance, a longer term payout that was put in place for a couple of them. So a caution flag here, because of the customization that's available in these programs and the 409A and the 457 legislation that dictates what you can or the employers can and really can't do in the drafting of these plans. It's important to engage specialists in these types of programs. There's financial planning pitfalls that need to be addressed in the specific advice provided to both the employer and the employee. And our team is experienced in the several planning areas important to proper and appropriate employee benefit plans, from legal financial advice to the design, implementation, and administration and funding. Sorry, that was a pitch in this, Gene, I hadn't seen for quite a while in this last bullet, but it summarizes that we could certainly help in all facets of the design and implementation and funding of these programs.
Thanks, Bob and Gene, very much. Great information. We've got a handful of questions now. I'll run by you. There's a couple for Bob, a couple for Gene. I'll go back and forth. Bob, you mentioned that an employee could also contribute to the performance-based plan. Can you confirm that that would be pre-tax? And are there any limits to what they could contribute? And how are these funds invested?
Okay, all right, I'll start at the beginning. Yes, the employees can contribute, and it would be on a pre-tax basis. I'm sorry, what was the second part of that question, Fran?
Yeah, how are those funds invested?
So typically the company will allow a menu of investments, and many times it's similar to the 401k plan. So you've got a couple options. One is the company can credit a fixed rate to whatever funds are in the plan. That's the easiest and simplest to account for. The second one is a 401k lookalike menu. So there's the ability to have exposure to multiple asset classes, and again, just invest very similar to the 401k plan. And third, it could be tied again to the company so that there could be a discretionary crediting rate the company can apply to those funds as well. So there's multiple options on how those funds can be invested over time.
Super. Gene, is there a method or strategy to deduct a selective benefit?
Sure. You obviously have a choice of leaving the benefit inside the company. Effectively is a promise to pay in the future, and then you make a decision to fund it or not fund it. Or you can do what's called a bonus 162 plan, where the company, for example, a lot of times, and Bob and I were just talking about this earlier, a lot of times we'll have we want it deductible now and we want it off the books. And what we'll do is we'll pay a premium either into a life policy or an annuity, and we'll fund for the benefit each and every year by making the premium payment into the contribution. We can put an assignment against it. The person can't touch the dollars until they're retired. And then each and every year there'll be a tax, and then the company has the decision. They can either gross up the tax liability, and in most cases that's what they will do, or the executive can pay the tax. Most of the time they'll gross up the tax liability so that it's deductible fully to the company and the benefit is off the books, and you keep a wrap around it so you really can't touch the money until a restrictive endorsement until retirement or when you leave.
Super. Bob, can any of the case study plan values be rolled into an IRA or the company 401k plan once they vest or once payments begin?
The quick answer is no, unless it was set up as an IRA for some reason, the company contributing to their individual IRA. But these, all of the plans that Gene and I were discussing are considered non-qualified plans and have to be set up essentially on their own. Monies are at risk based on the creditworthiness of the company to actually pay those benefits out. And when you get to retirement, there is no option to roll those otherwise taxable funds into your own IRA. So it's a standalone plan that gets taxed separately from your other qualified retirement accounts.
Great. Gene, can I protect the company and protect the executive pre-retirement and provide a retirement benefit?
Sure. I mean, we have many times on that manufacturing company. What we did is we bought a life insurance policy on the executive's life, and we left some of the death benefit to the company as key man and some of the death benefit to fund the liability. And the cash values in the contract can be used at a later date of retirement or just held and paid from other resources. But yes, you can always protect the company pre-retirement.
Super. Bob, it looks like the last one for you. I have a client with an old pre-2000 split dollar program for several key people who are now retiring or soon to retire. Can the employer roll out its assigned share of the cash value without tax consequences to the retiring exec?
Okay, so that's a loaded question. These early split dollar plans, assuming it was a collateral assignment, where essentially the individual owns the policy and he or she assigned back the cash to the company in an amount equal to the premiums that were actually paid on their behalf. When they were put in years ago, there really was, the IRS was silent on the taxation of that program. It was a terrific tax tool, accumulation tool for the individual insureds. But what's happens fast forward in the implementation of 49A, if the employer wants to roll their share out, essentially release their share of cash to the employee, the IRS is going to look at that now as a deferred compensation payment and should have been accounted for and prepared as a deferred compensation payment under 49A with a separate plan agreement. So the long-winded answer to this is there's more to this, and there are some workarounds. There are some clear workarounds, but there's a few steps the employer would need to take to do that. Regardless, whenever that cash would move to the employee, whether it's through a deferred compensation plan or just a release of the cash, it'll be 100% taxable to the employee. I think that was one of the parts of that question.
Absolutely. And last question, Gene, what do you mean by reverse discrimination for disability?
Well, I think I mentioned earlier, but what happens in a company, let's just give an example. You have a group plan that says, I'm going to replace, for simplicity purposes, 60% of compensation up to 10,000 a month. So a person who's making 200 grand will be fully covered by the disability plan. A person making 300 on the next 100, they're not covered at all. So the idea is that the person making 50 grand is fully covered for the first 60% of their salary upon disability. So in a sense, the highly compensated are being discriminated against because they're not getting the same level of benefits the non-highly compensated are. So that's where the carve-outs make a lot of sense. You also see it in group life. We're going to give you 3 times compensation, 3 times salary up to 500,000. Well, if a person's making $500,000, they're capped at 500,000. They're missing out on the extra coverage. So a lot of times we'll go in and we're just equalizing the benefits they're losing due to the plan formulas.
Super.
Okay.
So first of all, I want to thank both Gene and Bob today for their expertise. Obviously, there's just so much of an in-depth conversation you can have about some of these particular strategies, which are very complex. This particular recording will be put up on the website. If you go to www.strategiclifelines.com and you scroll across the top, you'll see previous webinars. It should be up within the next several days. Also, if you scroll down to the bottom of the website, if you have some additional questions or you'd like to connect with us to discuss a particular case, you can just request a consultation. I want to give you an idea of some of the upcoming events we have. We're really excited about our quarterly webinar in January. It'll be Tuesday, January 11th at 1 o'clock Eastern Daylight Time. Will be the value of understanding premium financing for your high net worth clients. This is a real fascinating topic. Very high net worth individuals need to create liquidity in their estate to pay taxes, but most of them don't dislike insurance. They just dislike paying for it. And we're going to show you how you could actually place large blocks of insurance in force for high net worth individuals with no out-of-pocket costs, no personal guarantees. It's as legal as the day is long, very low interest rates, no personal guarantees with long terms in them. I think you're going to find this an extremely interesting topic, especially if you yourself, if you're listening in, or if you have any clients that are worth in excess of 20 to 25 million and growing their estate. This is probably something that they're going to at least want to know about to make an educated decision if it makes sense. Then our case study on Tuesday, February 15th at 1 o'clock Eastern Time will be the benefits of a fully insured wealth management plan, a plan that basically will complete the face of debt, disability, take care of long-term care, create a significant tax benefit, competitive rates of return with liquid access to capital. It's a very interesting plan that once you understand it, most people realize it's worthy of some part of their overall financial strategy. And then the case study for March 15th at 1 o'clock Eastern Standard will be protecting your most valuable asset, your income. So I want to thank everybody that joined us for today's seminar. I thank both Gene and Bob for sharing their expertise again. This video will be up on the website, strategiclifelines.com, probably within the next 2 to 3 days if you want to watch it. And if you have any situations that you would like to discuss with us, just go onto the website and request a consultation. So gentlemen, thank you very much for sharing your expertise with us today. And everybody, thank you very much for listening in. We wish everybody a happy holiday, and we look forward to reconnecting with everybody in the new year.
Thanks, Fran.
Thanks, Fran.
Bye-bye, everybody. Thank you.